Thank you everyone for joining us. We're going to be talking about crypto taxes. The point of this panel is to have the experts on stage who can educate you, make you be able to walk out of this room understanding what needs to be done in simple steps that we all understand. We will be speaking largely as a UK tax resident, but the crypto world is international and global, so we will be able to cover some of those subject matters. So I'd first of all like you each to introduce yourselves and your area of expertise.
Thank you. Hi, my name is Magnus Jones. I am the Nordic blockchain and innovation lead at EY, Ernst & Young. So you know I come from the Nordics. We have clients all over the world and also working with UK companies. So we work literally A to Z, everything within this landscape of tax and legal structuring towards audit, accounting, bookkeeping, fraud forensic investigations, also technical implementation. So we work with all parties from the ones that go straight into a DAO structure towards more on the other corporate side, including also governments. So among others, assisted Norwegian tax authorities on issuing world's first guidance on how to tax NFTs, world's first guidance on how to tax DeFi, and now we're working on world's first guidance on how to tax DAOs. So it's literally everything within this landscape. So looking forward.
Hi, I'm Louise Lane. I'm head of crypto at Wright Vigar. We're a traditional firm of accountants, an independent firm. And we got into crypto about 4 years ago. We work really closely with the crypto tax calculator, helping them build their product. We wrote a UK tax guide on crypto for individuals. So in fact, me and Joe do a lot of work with HMRC, Treasury. We work really closely with Crypto UK on their tax working groups, really trying to shape the future of the tax legislation.
Thank you.
Hello everybody, good afternoon. My name is Tony Dhanjal. I'm head of tax at Koinly, a SaaS software which doubles up really as a portfolio tracker to begin with, and then a crypto tax calculator. And so not only do we cover the UK jurisdiction, if you're a UK resident, basically we're multi-jurisdiction, 100 plus countries, the US, Australia, Canada, just as a few examples. I myself am a qualified accountant and tax advisor by background, and likewise we work very closely with the likes of HMRC, Crypto UK, in order to keep up to date with legislation, to develop the product, and really our slogan is to make taxes easy.
And also congratulations, because I hear you're a new father.
Thank you very much.
And still made time for the panel.
A healthy baby girl. Thank you.
First of all, I'm surprised we've got this many people in the room to talk about taxes, but I guess that's a good thing. So I'm... Yeah. They're all trying to stay out of jail. So I'm Joe. I am the founder of an accounting firm called Nephos. We about 4 years ago, we first got into crypto, working with a couple of exchanges, and 2 years ago we set up Myna, which is our solely focused crypto arm. We work with businesses, individuals across the sector. It doesn't matter kind of what you're doing and how you're doing it, we're there to kind of support. So we've grown exponentially over the last couple of years and looking to support more of you.
Wonderful. So we'll start off understanding the landscape of how crypto is taxed, because we're all familiar with tax and we know that there's different types. And also you can be an investor, an individual, you can be a business. So Louise, if we're an individual investor or we deal in crypto in any way, shape or form, what are the things that we need to be aware of?
Yeah, so for individuals, most people are going to be taxed as an investor. So for your activity, you're buying and selling of crypto, you're going to be subject to the capital gains tax rules. So when you make a taxable disposal, you need to value that, work out the sterling value of that crypto, and then you deduct the costs that you originally paid for it, although it's not quite that easy, and that's where Koinly comes in, because you have these average cost pooling rules, which can be horrendously complex. So, if you've got a gain, you pay capital gains tax. The maximum rate in the UK is 20% at the moment, which isn't too bad if you're making lots of money. The biggest question is, when's a taxable disposal? So most people expect a disposal when they cash out for fiat. That's a given. But HMRC sprung on us a few years ago that actually when you trade one token for another, that's a taxable disposal. And of course, in that situation, you've got no sterling value attached to it, and we need to for the tax position. Again, that's where Koinly would come in. Like more surprisingly, if you use crypto to buy something, whether it's a product, a service, a software subscription, most commonly, every little transaction fee that's in crypto, that's a fractional disposal of your crypto that needs to be accounted for. Again, segue to Koinly. So the other disposals we need to think about is when you make a gift. So giving it away won't be tax-free unless it's to a spouse or a qualifying charitable donation. And then finally, in February of this year, HMRC sprung what they call their DeFi guidance on us, which isn't really, DeFi doesn't really cut it. The terminology's poor. But the crux of it is that when you go into any kind of yield-generating protocol, whether it's staking, lending, borrowing, adding collateral to get a loan, you've got to consider whether or not there's a transfer of beneficial ownership of your tokens to another party, protocol, platform. And if there is, HMRC think that there's a disposal for capital gains tax purposes at that point. And then again, when you come out of the protocol, we're going to dive into that a lot more closely later.
Yeah, I mean, we could segue onto that. I mean, we've got a bit of a structure, but as with these things, they kind of flow, don't they? So, I mean, on the liquidity pool side of things, the debate we're having at the moment, and we've both been key to talking to HMRC about the DeFi legislation, is when you put in your tokens into a liquidity pool, is there an economic disposal? So are you giving beneficial ownership to the provider of that pool? And my argument, especially in the DeFi world, is 9 times out of 10, no, you're not. Probably 9.9 times out of 10, no, you're not. And the underlying smart contract doesn't allow the protocol itself to access those funds and use those funds for its own benefit. So therefore, where's the economic transfer? So we're trying to talk to HMRC at the moment because softwares like Koinly can obviously only follow the rules that are put in place. And at the moment, HMRC are determining that any entry to a liquidity pool will classify as a disposal. So we need to bear that in mind. For a second reason, impermanent loss. I'm sure most people in the room are familiar with the term. If we go into
if you can expand actually on what impermanent loss is.
You're very mean.
I'm not most people in the room, obviously.
So impermanent loss is when, in a simple form, is when the underlying assets that go into a liquidity pool don't move in exactly the same proportion at the same time. So if you've got USDC and ETH in a liquidity pool, if the rate of ETH moves at a different rate to the rate of USDC in proportion, then you will then see an impermanent loss. You could also see an impermanent gain, but more often than not, you're going to see impermanent loss. So it's really hard to talk about this subject without getting technical, but ultimately, if you are disposing of that asset when you go into a liquidity pool, and then you're reacquiring that asset, in inverted commas, when you come back out of that liquidity pool and you've got an impermanent loss situation, your base cost that you are carrying forward is lower than what went in. So the asset value, the tax that you could pay would be on a higher asset value than the asset you've actually got. So it's quite a complex area that we're really trying to negotiate with HMRC at the moment because it is detrimentally affecting DeFi users in the UK. So yeah, we've kind of jumped on slightly from where we were, but that kind of covers the LP position.
And in the same way within DeFi, within calculating interest, because that you can receive in many different ways. Either it's continuously by second you receive it, or maybe when you have access to it. That's what Norwegian tax authorities, as the first in the world, said something about. They said, well, we know that it might be for tax legal reasons, per se, each microsecond you receive them. But that's totally impossible for us to handle, totally impossible for you. For practical reasons, we will agree to say that in Norway now, we say it's from the very first time you take that asset out of the pool, you have access to it, but when you take it out, that's the time when you calculate sort of the input value of it.
Yeah, so from a UK perspective, I guess it's slightly different in that if your liquidity pool assets are receiving farming rewards, etc., those farming rewards, as soon as you click claim on that farm, that will be taxed as income tax at that point. So we've got, like Louise said, the capital gains tax rate is actually quite low. It's 10% up to 50k and then 20% over 50k. And but the income tax rate, although the Chancellor has done something this morning, is much higher. So it's 20% and 40% above. So so those farming rewards you receive can actually be taxed quite highly. So it's worth bearing that in mind as well.
And I just want to jump in here, really, with regards to most of us are probably UK tax resident here, but there may be a few of you that are considering, well, how do we compare with other jurisdictions, other countries as such? And certainly at Koinly, we cover a cross-section of geographies across the world. And, in my view, certainly when it comes to capital gains tax, we're quite generous here. It's 10%, 20%. We've got the personal allowance, and HMRC actually did an uptake and undertaking research report and actually established that something in the region of 60-70% of people won't even exceed the £12,300 personal allowance if you're an investor. Now, let's compare that to places like the US. You don't get that kind of a personal allowance at all. Although in the US, they will split your investor gains into short-term and long-term, and it's only if you hold it for more than 12 months, we don't have that in the UK, then your capital gains tax rates go down. If you're in Germany, for example, again, there's a short-term, long-term split. If you hold it for more than 12 months and there's your incentive, there is no tax at all. And in fact, they actually bucket it into income tax as opposed to capital gains tax. Places like Portugal, for an investor, and probably some of you might be thinking of going over there, it's actually a tax-free environment for individuals, not businesses, for individuals as such. And also there's big distinct differences as to how the cost base is calculated. As Louis said, we've got this complex Section 104 ruling, and to try and figure that out on your own piece of paper spreadsheet is a headache. This is where obviously it alludes to getting that piece of software to help you do that. Whereas in the States it's FIFO, first in, first out. Ireland is similar. And the last point I just want to make on that, maybe a little bit of a tax tip for you all, it's certainly not sort of financial advice, but a tax tip, is if you are in the UK, obviously we've got our bed and breakfast same-day rules, where if in this bear market you're cashing out, you're disposing of a particular coin, you make a loss and you attempt to buy it back, then those losses will fall under these rules and be negated. The US at the moment, there's a loophole, the same as in Ireland as well. So if you're from those jurisdictions, my advice is make hay while the sun shines.
So just by way of show of hands, how many identify themselves as someone who's a crypto investor but will fall under these rules? And then, so we're talking about individuals there. How many of you have a crypto business? Okay, so what happens when you're a crypto business? Let's talk about the landscape there.
So I think the simplistic way to start is look at the underlying business model that you've got. So what service are you providing? What product are you providing? And what's the underlying business model that you've got there? If the underlying business model is something that would be taxed in a particular way, that at the moment, that is how we're having to read the guidance, because there's not very much guidance at all. So an example of that would be VAT in the UK. So, people ask me all the time, what's the VAT implications of this? What's the VAT implications of that? Obviously, it's a case-by-case basis in this space, but for example, let's take an NFT project that offers a membership to a club or, tickets to events, something like that. If that ticket, if that service would have been VATable under kind of traditional fiat money, then it's likely that the same basis will apply for the NFT version of that, because ultimately all you're doing is changing the medium of exchange. You're not actually changing the underlying services or product that's being provided. So that is the simplistic way at the moment. The guidance is pretty crap when it comes to businesses. It's much stronger, although it's debatable, but it's much stronger for individuals. So like I say, the first thing I would do is just look at the underlying business model, what you're trying to achieve, and how would that be taxed under normal circumstances, and the likelihood is that's how we would apply it for a crypto basis as well.
I think you should also think about it. If you are investing as a private person, then you pay your private person tax regardless of the jurisdiction, while as a company you will normally have to pay double tax on it, sort of saying, if you're not reinvesting it in a company also. So there might be various different reasons for why just keeping it as a private person, but also what we see in the mix of that one when dealing with authorities, if you have received the control and you have the combination of a private and a business side on it, is rather that, there's rarely any companies out there who has actually a wallet not connected to the company. It's the private person or 1, 2 other 3 persons in the company. That looks suspicious for an average tax handler. So it's lots of complexity towards these things, while they also might have done private trades within sort of the company wallet that makes complexity. So my core recommendation towards this is keep track of whatever things you do. It's stupid to say, and regardless of, we have great tools like Koinly out there, there's lots of complexity, even if it's on the ledger, where you need to recall and think, what did I actually do then? Did I buy on behalf of my mother? Did I buy on behalf of some friends? Or was it someone else that I don't even know? So I actually recommend, how stupid it sounds, and within this sort of digitized world, that actually keep a track in Word or Excel, whatever. Don't write extensive, but just keep the dates and time and whatever you did, and that will help you a lot. I mean, a lot, if you receive a control of your accounts in 1, 2, 3, X amount of years.
So I have a question that we didn't discuss, so fun. You say that if you pay for anything by crypto, that's considered a disposal. If you're an investor, I understand capital gains tax, but what happens if your income is in crypto? What are the tax implications like then?
Yeah, I'll take that. Yeah. So if you're receiving your income in crypto, so we're not talking about yield farming. We're talking about maybe you're a consultant and your business is providing consultancy. You get paid in crypto. You could be an employee as well. It's taxed at the date of receipt. So, you know, if you raise an invoice and receive the funds, the date you receive the funds, you convert to sterling at that date, and that's your taxable income. So you still need to work out if you're an employee taxed under the pay-as-you-earn system, or if you're self-employed and you have to add that all up and put it on your tax return, but you can't ignore the payments you receive in crypto for work done like that. You just have to tax it at the date of receipt. I think the most important thing that people miss is that if you're working as an employee for an employer that has no presence at all in the UK, and we see that a lot, do you? You don't get away with the pay-as-you-earn implication. You're never going to get that overseas employer to sort out your pay-as-you-earn for you. You're actually required to set up your own pay-as-you-earn scheme and deduct your own pay-as-you-earn, your own NI, and pay that over to HMRC. And that's a point that really gets missed.
Yeah, I totally agree. And the other point to that is, again, I'd like to come back to we can kind of ignore crypto, right? If you are paid by an international employer, it doesn't matter whether it's crypto or not, that same rule applies. So it comes back to, what is the underlying function? What are you doing? Are you employed? If you're paid in crypto or paid in fiat, it's irrelevant. The same rules apply to pay-as-you-earn, et cetera, as Louise said. So again, it's people kind of have that misconception of, I'm paid in crypto, therefore it must be a different rule, but it's not. It's just the medium of exchange. If I decided to employ some of you and pay you in sweets, and that was what you decided that you were willing to exchange, what is the exchange of value that we've got there? What is the service that you're providing, and how am I paying that for you? It doesn't matter. It's the underlying service that's being provided, I guess. So that's useful to remember.
And similarly to, just to make that distinction between income coming in from, say, something like staking or yield farming, where it's, in the UK, it's swept up under the Miscellaneous Provisions Act, which is only income taxable. And here, for employment income, you've still got the national insurance that you've got to consider. It's still class 1, both on the employees and employee side. And again, as Joe said, it needs to be converted to sterling, and it's a normal process. And even there, it's always recommended that you have a PAYE payroll software in order to process this.
One more quick question before, and then we'll move on. So if you can prove that your crypto was income, you were taxed as income, and then you dispose of it because you're paying your way that way, are you still liable to capital gains tax?
Only if it's changed in value. So at the time you receive it, let's say it's worth £100 a token, and then when you sell it, it's worth £200 a token, ignoring the average costing rules, you've made a profit of £100 a token for capital gains tax purposes. So if it fluctuates in value up or down between receiving it and selling it, then you've got a gain or a loss.
And I think that the difference here again is we're talking about crypto as if it's a different thing, right? It's the value that you've received. So if I paid you in land outside here, and that land goes up in value, and then you dispose of it, there's a capital gain on that. Do you know what I mean? So
Okay.
it's
Yeah.
getting away from, that's what I'm trying to get at here, getting away from this crypto, go to what the underlying transaction is, and you'll find the answer there.
And speaking of crypto, I came into space in 2017, came down the Bitcoin rabbit hole, and then we had cryptocurrencies. Of course, now we've seen DeFi, yield farming, staking, we've got NFTs, we've got child NFTs, we've got the metaverse. So can we have a discussion around what do we have to think about when it comes to tax on those circumstances? I'm going to pass the mic.
Yeah, sure. I think lots of people. One thing is that if you have an easy buy, hold, sell mechanisms of crypto, and that's, I would say, fairly easy to handle. And specifically when you have great tools where you can just extract, and if you buy it from an exchange, you extract just the whole file and upload it to, i.e., Koinly or others. But when it comes to other crypto elements, such as, i.e., for example, NFTs, there's several different elements that you need to take into consideration. So just to, as a start, as an NFT, that is also a token element. It is de facto the same as crypto currency as you think of it, but they have slightly different attributes in the code. So as a main rule, they're taxed in the same way based upon the same principles that we said here about you receive something, you have an input value, you have an output value, and you have to report capital gains and keep track of everything that you do. But the challenge might be on if you buy a Bitcoin or an Ether or a Dogecoin, whatever, there's liquidity in the market. There's several places trading it, hence you have official exchange rates. While if you buy an NFT, it might be just a one-off, or maybe it's 10,000, or some might be rarer than other ones. And the question is rather, when you acquire them, you get an input value. That most likely is the value that you acquire it from an exchange, or you might receive this as well. Was it zero value, or was it what you purchased it for? Purchase value is fine, but if you just received an airdrop, maybe it was zero, but maybe if you received something like here, if they had said to you guys, come here to Zebu during this one, just reveal your wallet to us, and you will be in the competition of the draw of getting a crypto, whatever it might be, an ape, a moonbird, whatsoever. Then if you receive that on, that doesn't have zero value. It has the value of transaction level. But if you are to be considering at a level where there's not that many trades, you have to put in a fair value. And what authorities, when we are working all over the world, has said, you have to put a fair value. That's most likely not zero. It might have some slightly value if it's traded, but as long as you can document whatever that you have made an interpretation around it, that is what you need towards the authority. And the case is here that you need it either for when you sell it or by the 31st of December when you have, if you have a wealth tax in your jurisdiction, to report the value there. So well, like I said, you should always be able to pass the flush test, and that's if the tax authorities show up under control and you start to flush when they ask questions, then you might have put in the wrong fair value of that asset. So that's one thing that you need to take into consideration. And another thing is, like what many people tend to forget, like you mentioned on DeFi, etc., is that when you just move into this one, you stake something, you put something in, people tend to forget that's a taxable event as well. You bought Ether for 1, now it's worth 100, you stake it into a smart contract as collateral, well, that's a capital gains tax that has to be reported and paid. And in the same way with NFTs, that you can also put this one in, as collateral within the DeFi ecosystem, as we've seen. People are putting in like 101 CryptoPunks and take a loan in MakerDAO, and one guy got 8 million DAI and put out a further lend on that one, use them as collateral. Think about when you do these things, that has taxable elements. So if you put in your NFTs in a staking algorithm, you get a new input value. You acquire a CryptoPunk in 2017 for free, 0 in input value, but when you get it back and stake it, it might have $1 million in input value. If you lend out your Bored Ape to a friend who was in New York to go to a cool ape party, well, guess what? For tax reasons, you are transferred from one wallet that you control yourself to another wallet that you don't control yourself, hence you get a new input value. And most likely also, even though you just lend it out, tax authorities might say you have to pay a capital gains tax on it. Take that one into a more relevant setting in gaming. For your kids, for example, they have a sword, a skin, a pair of sneakers, whatever, within gaming metaverse world. they think about that as virtual assets that they just send. Oh, you need this for the weekend? I will send it to you. You can lend it back and forth. They don't think about it. If they are under the legal age, well, then it's you as the parent that is responsible. So what I always say, don't care that much about what your kids are watching on the internet. Rather care about what they're doing. That's sort of the thing there. So I have several other elements that I think is important, but I'll pass the word here so we can discuss further on the NFT areas as well.
I just get notifications on my phone that says your son has just bought this on Apple Store, or Minecraft, or Roblox, or whatever.
It's the killer application for Koinly. The perfect birth control.
Absolutely.
I think everything you said, I totally agree. And one of the big things that we're challenging at the moment with HMRC here is that collateralized debt model being taxable, the disposal when you go into a liquidity pool. But what we're trying to challenge is where there's an economic change of owner. Now, as you said, Magnus, if I send it to any one of you and you guys go to an event using that, and it moves from wallet to wallet, and it's not a wallet I control, naturally, there's nothing you can do about that. If that's how you do it, that is going to be a disposal. But if the loan is collateralized on a smart contract platform where you haven't given up beneficial ownership, that's what we're in the UK trying to make not a taxable disposal, because you haven't actually given that up. So that's the first thing. The second thing I think with NFTs, and we had this discussion in the team, and eventually we had to really kind of think hard and speak to HMRC about this, because with NFTs, so as we said briefly a minute ago, the rules around crypto tokens in the UK are an average cost basis. So we have this Section 104 pooling mechanism where we average the cost together, and that's what we use as our cost for our sales disposal. But that's because you can't differentiate between a Bitcoin I have and a Bitcoin any of you have. They're all the same. There's nothing different about the Bitcoins that we own. Whereas with NFTs, there is a difference. There is a unique token ID. There are unique traits, things like that. So we started discussing, well, clearly these can't fall into the pooling mechanism because they aren't pooled together, which is fine. But we thought there'd be a loophole there that you could sell those NFTs at a loss, buy them back quite quickly, and avoid the rules that we talked about earlier. But actually, those two are two very separate things. So the reason I talk about that, I realize it's a little bit technical. It's really important that we remember that the same rules apply to that 30-day buyback, which is what we talked about earlier, that when you sell a token, if you buy it back within 30 days, the loss that you may have is negated. That's the same with NFTs. So whilst the pooling mechanism doesn't apply, that 30-day rule does apply. So it's really important to remember that you can't tax loss harvest, as they call it, NFTs, even though you might think that it would work, it won't. So
I think what I'm learning on this conversation is that half an hour isn't going to be nearly enough. I don't know how the rest of you feel, but I hear problems. So can we talk about what the solutions look like, Tony?
I've got one, yeah. So these new DeFi rules from HMRC, where they're trying to take a lot more capital gains tax, they're saying when you go into staking, lending, collateralized loans, LP pools, we think there's a capital gains tax charge if there's a change of beneficial ownership. I'm really encouraging my clients to look carefully at their staking protocols. I know the instinct is to think, well, there's no change of beneficial ownership, I'll not worry about that. But if you look really hard, because of the market we're in, you may find that when you went into a staking protocol, your tokens were standing at a loss. Wouldn't it be amazing if you used the HMRC rules against them and crystallise that loss and reduce your capital gains tax bill for this year? That's
just don't come out the pool within 30 days.
Yeah.
And I guess in all of this, there's a lot of complexities, as we can clearly see, around crypto, DeFi, NFTs, the tax implications. And I guess just to use an analogy here is if you're all facing, obviously, the proposition of doing your taxes, if you have had gains or even losses as well, they're very valuable, is, how do you practically get over that? How do you practically deliver your returns, with in the most efficient time possible? I mean, there's a balance here. You don't want to be spending weeks or months doing your taxes, going through spreadsheets. You could accumulate, just through DeFi staking, you can accumulate, hundreds of transactions are just coming through. and it is a real headache. So I say there's 4 things that you'll need to consider any software should do for you. Software should be the leverage. It's the time saver. It's the pain saver. You also need to be able to grow with software. You know, you could be a very beginner in terms of an investor or a business, going to an intermediate level, and then be able to, maybe there'll come a point that you want to start working with a professional, like an accountant, a tax advisor. They need to be able to sort of, you know, be invited into your software in that respect. And so therefore, really, it's all a case of, you know, do you use one single horse to pull the cart or the 10-ton lorry, or do you use a super power 250 brake horsepower, you know, engine? It's all about that. So certainly, Koinly is one of the options out there for you, and you know, it can be as little as 20 minutes just to do tax returns. All of this stuff that we talked about is built in. There are some judgment calls you have to make. Yes, I do admit, but most of this is built in, and 90% plus is automated as well. So that's where you really want to be in terms of your practical application.
So the wonderful thing about having this panel is they're the people who can provide you with the solutions. Just a quick show of hands, who would like them to stick around so you can ask some questions after this panel? What? Yeah, there's a few people. So I invite you to do that. Unfortunately, we're running out of time, so if you can each have one key takeaway or one last thing that you want to share with them. Magnus, can you start?
Sure. I would say that everything is doable, but right now the landscape is evolving so fast that even though that, you know, Koinly has a very good basis around it, it's literally impossible for anyone to cover all aspects because the landscape is developing as we're sitting here speaking. So that's down to, you know, if you have basic, easy transactions, keep track of it. So back to my last advice, keep track of everything you do when it comes to crypto assets, so we have the timeline at least, so we can go back, so we understand what you're doing. And also that, you know, if you look into tools and Google just crypto tax tools, whatever, you find lots of different solutions out there. Some come from other jurisdictions, and they might have been set up default on the US jurisdiction about what you mentioned about first in, first out principles. And it might be tempting to say, oh, if I just check this box there and this box there, oh, I don't pay any tax, but if I play this one and this one, I have to pay $1 million in tax. I'll just go with this one. So there we see clearly from the ones that are doing heavy DeFi trades, they use, almost all of them use Koinly as one of their preferred tools. But if they have advanced setups and they've been trading for others, etc., you need to extract this manually. And that's back to where I say, keep track of things, otherwise you will make yourself a disfavor, because authorities, they will not look into it now because they neither have the resources, the competence, nor the core tools right now. I travel all over the world. I never met any government that has more than a handful of government people who knows basic buy, hold, sell mechanisms. If you ask NFTs in detail, DeFi, forget about it. So they will come in, I believe, 2-3 X amount of years and open it retrospectively. Then it's no fun to open it. So that's my 5-cent document, whatever you do in this regard.
Yeah. Following on from what Magnus says, my tip is to really tackle it now. If you've got a personal tax problem that you're just festering on, the deadline for filing for 21-22 is January. Don't leave it to December. Don't even leave it to November. You need to be tackling it now. And even if you don't have a problem until the next tax year, it's really good discipline to look at that data, get it into some kind of tax software. There are lots of crypto tax calculators out there. Find the one that works best for you. You can use most of them for free without, you know, just while you're trialing it and getting your data in. And you'll get a handle on your tax position, and then you'll feel a bit more comfortable with life. And it is quite a long process to get a handle on it. And the sooner you start, the better, definitely.
From my point of view, being that we've been in a bear market and perhaps that's still continuing, there'll be a few of you probably, or a lot of you, who are sitting on paper losses, as we know them. And if you do crystallising meaning if you actually then decide, okay, I'm going to get out of this particular token coin, you could have crystallised a loss. Just make sure you register those losses, because there's this conception that, you know, well, I only have to fill in my tax return if I've made a gain and it's tax due. You don't pay tax on losses, but they're very, very valuable in terms of using going forward to offset even in the current year or future years. But if you don't register them, HMRC are never going to know, and you've got a 4-year limit and it's easily forgotten. So there's my tip for you all.
Yeah. All the tips have been stolen from me, which I think is a bit unfair that I had to go last. I think There's a couple of points just to pick out from these things. You know, tracking is clearly important. Keeping a record of everything is really important. One thing on that I would also add, especially if you're in obscure tokens or you're being paid by a network that's just started, keep a record of the USD value at the very least and the USD rate on that day if you're going to go back to GBP. Because as you'll probably, if you look at the USD rate today, you're going to see a huge tank in the market, right? Look at that 6-9 months ago, and if you're converting at a previous period, at a previous rate, because you haven't got the historic data, make sure you've got that historic data available to you, is what I would say. So yeah, along the tracking and the losses in the bear market.
So I know that we have loads more to talk about and discuss, but we haven't reached our time. I want to be respectful for the other panelists. So thank you very much. But I know you'll have loads more questions, so do follow up with our experts after
We can do one, just a comment, because there's several people who has asked about the Ethereum merge and tax implications, and there's significant, very important complications about when you get a hard fork there. So if anyone is interested to talk to us afterwards, just reach out. They're more than happy. And as the last 5 cents, also comment when you send in your annual tax return. Reveal everything you have done to the authorities, because if you have done that retrospectively, they will not be able to give you additional taxes and fees. You will have to pay your original taxes that you're supposed to pay, but if you have not reported them, they can give you additional taxes and fees. If you have revealed everything to them, they cannot give it to you. So that's a friendly advice also, to actually provide the details on your annual tax return. Make the description of every move you have made, and then you will be in a much better position and be ready.
And a round of applause for our panelists. Thank you very much.